Have you ever heard the phrase, "Don't put all your eggs in one basket"? It's simple advice, but it's also the core of one of the most powerful financial strategies in history: diversification. In the next 10 minutes, we're going on a journey to uncover how this ancient wisdom became a Nobel Prize-winning science. We'll explore what diversification really is, how it works, why it's crucial for your financial health, and how technology is reshaping it for the future. Stick around, because understanding this one concept could completely change the way you think about investing. Let's start at the beginning. The idea of diversification isn't new. It's an ancient survival tactic. Imagine merchants in ancient Mesopotamia or Renaissance Italy. To send their goods across the sea, they wouldn't load everything onto a single ship. Instead, they'd split their cargo among several vessels. If one ship sank in a storm, they wouldn't lose everything. This simple act of spreading risk is the ancestor of modern portfolio diversification. As markets grew more complex through the 18th and 19th centuries, this common-sense approach evolved from a merchant's rule of thumb into a foundational principle for any prudent investor, helping to smooth out the bumps of volatile economic cycles. For centuries, diversification was mostly intuition. That all changed in the 1950s with an economist named Harry Markowitz. He developed what we now call modern portfolio theory, or MPT. Markowitz used mathematics to prove that you could reduce the overall risk of your investments by combining different types of assets, especially those that don't always move in the same direction. He introduced the idea of the efficient frontier, a sweet spot where you can get the highest possible return for a specific level of risk. This was revolutionary. It turned diversification from a gut feeling into a quantifiable science. And his work was so groundbreaking that it earned him a Nobel Prize. It laid the groundwork for how professional asset managers build portfolios today. So, how do you actually diversify? It happens on multiple levels. The most basic is diversifying across asset classes. This means having a mix of stocks, bonds, real estate, and cash, because these different assets react differently to economic events. A downturn in the stock market might be offset by stability in your bonds. Then there's sector diversification. Within your stocks, you spread your investments across different industries like technology, healthcare, energy, and consumer goods. If the tech sector takes a hit, a strong performance in healthcare can help balance things out. You can also diversify geographically, investing in companies in different countries to tap into global growth and protect against a slowdown in any single region. There are even more advanced strategies, like spreading out your investments over time to avoid buying at a market peak. The financial logic behind all this is surprisingly simple. It's all about non-correlation. In plain English, this just means that not all your investments will go up or down at the same time. When one part of your portfolio is struggling, another part is hopefully doing well, acting like a cushion. This balancing act is what helps investors achieve more consistent, stable returns over the long haul, without the wild, stomach-churning swings. For large institutions, this is non-negotiable. It ensures they have cash available when needed and provides a critical defense against major market shocks like a recession or a sudden crash. It's one of the most reliable strategies out there for growing your wealth while also protecting what you have. As the world became more connected, especially in the late 20th century, diversification got a major upgrade. Globalization opened the doors for everyday investors to easily buy into emerging markets, different currencies, or even commodities like gold and oil. The menu of options expanded dramatically. But this interconnectedness came with a new kind of risk. A financial crisis in one part of the world, like the 2008 meltdown that started in the US, could now spread like wildfire across the globe. This made some traditional diversification methods less effective, as many markets started moving in sync during a crisis. In response, savvy investors began looking for alternative assets, things like private equity, infrastructure projects, and hedge funds to build even more resilient portfolios that could withstand global shocks. And then, technology changed the game completely. Today, diversification is more accessible and precise than ever before. We have robo-advisors that can automatically build and manage a diversified portfolio for you based on your goals and risk tolerance. Sophisticated algorithms can analyze massive amounts of data to find the best mix of assets and rebalance your portfolio when it drifts off course. This isn't just for the big Wall Street firms anymore. These tools are available to everyone, and it doesn't stop there. New technologies like blockchain are creating ways to own fractional shares of things that were previously out of reach for most people, like a commercial real estate building or a valuable piece of art. Technology has truly democratized diversification, making it a standard tool for smart investing worldwide. Even with perfect math and powerful technology, there's one major hurdle to successful diversification: us. Human psychology often works against our best interests. We have what's called a home bias, which means we tend to overinvest in our own country's market because it feels familiar and safe. We also fall prey to herding behavior, piling into a hot stock just because everyone else is a classic case of FOMO, or fear of missing out. The pain of losing money also feels much stronger than the pleasure of gaining it, which can cause us to sell at the worst possible time. This is where behavioral finance comes in. By understanding these psychological traps, we can use technology to help us stay disciplined. Automated investing platforms can enforce our diversification strategy without letting emotion get in the way, making it easier to stick to the plan. Now, you might be thinking, the more diversification, the better, right? Not exactly. It's possible to have too much of a good thing. Over-diversifying, sometimes called diversification, is when you own so many different investments that your portfolio just starts to mirror the market average. Your potential for high returns gets diluted, and you end up with a portfolio that's complicated and expensive to manage without much benefit. The goal isn't to own a little bit of everything. It's to own a well-researched, deliberate mix of assets that work together. This is what we call smart diversification. It's about quality, not quantity. Professional investors focus on diversifying by risk factors, not just by counting the number of stocks they own, to find that perfect balance between managing risk and capturing growth. So, what does the future hold for diversification? It's going to get even smarter and more personalized. Imagine artificial intelligence that can analyze market data in real time, predict how different assets will behave, and automatically adjust your portfolio to stay ahead of shifts. But the evolution won't just be technological. We're also seeing the rise of diversification based on values. Investors are increasingly looking at ESG factors, environmental, social, and governance when building their portfolios. This means balancing not only financial returns, but also the ethical and sustainable impact of their investments. In a world that's constantly changing, this kind of adaptive, multi-dimensional diversification will be the key to navigating uncertainty and creating long-term value. Ultimately, diversification is more than just a personal investment strategy. It's a pillar of stability for the entire global economy. By encouraging investors to spread their capital across different assets and regions, it reduces overall market volatility and helps channel money toward innovative new companies and industries. But as our financial world becomes more complex and data-driven, the timeless principle of spreading risk remains our best defense against uncertainty. Whether it's guided by a supercomputer or a simple piece of ancient wisdom, diversification isn't just about surviving the downturns. It's about positioning yourself to thrive in a world that is, and always will be, unpredictable. And that's a wrap on our deep dive into diversification. I hope you found it insightful. If you learned something new today, please give this video a thumbs up. And do unforget to hit that subscribe button and ring the bell so you won't miss our next one. Thank you so much for watching. We have more exciting content coming your way, so stay tuned and we'll see you in the next video.